Good afternoon, everybody. Welcome back to those I briefly touched base with a minute ago. A fresh welcome to those who just joined us. My name is Harley Dale. I'm the Chief Economist for Creditor Watch, and this is the February webinar covering the business risk review results for the month of January 2021. We have some pretty interesting insights that came out at the start of this year, so I look forward to taking you through those results. Should you have any questions as we're motoring along, then please use your control panel, and we'll get back to you. The presentation will be available tomorrow, and so you'll be able to follow up to today's presentation. So I guess we'll look at who the heck I am. As I say, my name's Harley Dale. If you have any questions, then pop them through, as I said. And presentations available tomorrow. If you want any historical webinars, then they're available on the Creditor Watch website. So let's get into the results proper, shall we, and see what the profile for the business credit environment was for the month of January 2021. This is looking at the aggregated data and trade payment information for a huge amount of companies around Australia. It does provide us the opportunity to have key insights and trends for the business community for each month, looking at them state by state, as well as sector by sector, and of course aggregate data. There's a huge range of sources that all this information is collated from. ASIC and AFSA and the Australian Business Register, for example. The courts are a big source of information, although there has been some restriction there, obviously, with the nature of COVID lockdowns, and I'll have a bit more to say about that in the body of the presentation. Insolvency notices, register, debt collectors, Creditor Watch customers, these are all unique information sources that we have that can go into compiling this comprehensive review that we produce each month. So with that background, let's have a look at some of the key things we found. If we look at payment defaults, you can see that there was a fairly hefty increase for January 2021 when you compare it to December 2020. Bear in mind, though, that this data is not seasonally adjusted, and there are many pieces of data in and around Australian business and the Australian community where you do expect to see some degree of seasonality in the month of January. So perhaps a bit more telling, and that's certainly a bit more positive, I guess, that we see a 21% decrease in defaults between January 20 this year and January last year. So that's a good outcome. You'd want to see some persistence in a trend in terms of a decline in the annual rate. So a bit too early to get carried away, but certainly a very good result for the first piece of information that we received for the new year. We've got some standout industries that are performing really well at the start of January 2021. The mining industries are running very well, very minimal overdue payment times. Overdue payment times are only up by 3 days on December last year. Resources sector is still doing very well in the overall economy, with strong demand coming in from overseas sources, including China, despite the tensions that we have there, and other strong demanding countries such as Russia, for example. Information, media and telecommunications, good outcome there. No change in overdue payment times between December last year and January this year. 12 days overdue, and a 12% fall compared to January 2020. This is a sector that's been masked a little bit from the adverse consequences of COVID because of the nature of the sector, its ability to operate remotely more so than a lot of other on-the-ground industries. So that's a very good result. Public administration and safety is benefiting from the overall environment we find ourselves in terms of confronting the COVID pandemic. But we're seeing admin down 18% January on January, and up a fairly modest 7 days January this year when we compare it to December last year. So that's a pretty healthy profile for those three industries. Unfortunately, when we have good news, economists are pretty good at selling you bad news as well. And so now I've got to hit you with bad news, and that is that we do have some industries we're going to have to keep a pretty close eye on over coming months. You can see there administrative and support services, 67 days overdue, healthcare and social assistance, 66 days, transport, postal and warehousing, 47 days. Now, when you're comparing that to the 8 and the 12 and the 11 we were talking about on the previous slide, gives you some kind of indication of the wide disparity that we still continue to see in terms of how individual industries are faring in this challenging time. We're still seeing really hefty increases year on year for these industries, and there's been increases in the number of days overdue for healthcare and social assistance, and also for transport, postal and warehousing. So these sectors are concerning. These numbers have been worse in the past, but they're still very elevated, and they are industries that deserve our attention, as I say, in the months ahead. In terms of payment times overall, if you look month on month, it's actually not too bad a profile, is it? I mean, you've got moderately higher payment times in some areas, such as construction, such as professional, scientific and technical services, but you've got largely balanced results across a lot of sectors. You've got falls in a few sectors as well, such as retail, for example. So it's not a really bad bag of update, if you like, month on month. Does get a little bit more hairy, unfortunately, when we look at payment times on a year-on-year basis. I draw your attention to those 5 industries on the right-hand side of your screen: construction, professional, scientific, etc., transport, etc., healthcare and social assistance, and administration and support services. Now, of course, you've already just seen some of those really hefty percentage changes for those last 2 sectors on the previous slide. Transport, postal and warehousing is still struggling somewhat from reduced overall demand in the Australian economy, and the flow through lagged impact that is having with the nascent recovery that is starting to come through. Professional, scientific and technical services have been affected by the various lockdowns that we have encountered in the Australian economy and across various states and territories. They will take time to recover and get back up to full speed, but we do expect to see some relief in the coming months. I think you could probably say the same for construction as well. We do have a home builder program in place, as many of you would be aware. That's generating enormous demand for new home building, which also at the same time is generating vital employment in the construction industry. But we do have a very large commercial sector. We do have a very large engineering sector. They're not faring quite so well. Yes, we do have government stimulus by way of infrastructure investment in the engineering sector, and that is proving helpful, although there have been some disjointed projects and some delays that have been inevitable in and around the COVID environment. Commercial construction isn't receiving any form of explicit stimulus the way the new home building sector is, and so that's sort of more on its own 2 feet, if you like. And we have seen areas like, for example, office demand change very substantially because of the number of people working from home. We've had, sadly, a lack of retail demand, which has had an adverse impact on a huge number of small businesses, and also on employees of those businesses. You can see that kind of evidence if you're walking around shopping malls in Australia, and you can see the number of shops that have closed down, and the shop fittings have been removed. That's one of the real sad social stories of this whole situation that we're still going through, is that human cost. And we will find that the dynamics of our labour market over the next 6 to 12 months are still going to be quite demanding, and in some instances quite confronting. We do have an unemployment rate coming down from a lower level than we first thought. The unemployment rate peaked at 7.4%. It's now at 6.7%. Much better outcome than everyone feared would be the case. So that's a real tick for us, I suppose. But we were at 5.1% before the pandemic hit. So we've got some way to go, and there will be some ructions there. In terms of looking across the states, we do see in January this year a considerable decline in court actions compared to what we had at the beginning of last year. With this information, we do need to bear in mind that we had considerable court closures by necessity during the height of the COVID pandemic. It will take time to get that backlog easing off, and we also may well see some increase in court actions post March 31st. I might just pause there and remind us all that on the 31st of March this year, we see the end of the JobKeeper subsidy. Creditor Watch supports that time frame for ending that policy, but we are going to see a lift in insolvencies and bankruptcies in the June and the September quarters, and that will inevitably feed through into increased court actions as well. The good news is that compared to how things were looking in the middle quarters of 2020, it would appear that we're going to have a considerable number of businesses doing it tough and unfortunately, realistically, not being able to survive. But Creditor Watch data has increasingly shown since around October, November last year that a flood of insolvencies that many feared we were going to have starting in the June quarter rather this year. We're unlikely to see that. We're probably going to avoid that, but we do need to brace for the fact it's going to be a very different trading environment for a number of small and medium-sized enterprises post March 31st compared to that extended period of time where they've had that very important support from the federal government and other kind of supports too from state governments. But JobKeeper really has been the biggie that's been so vital to businesses over the last 12 months, give or take a little while. In terms of external administrations, this is a bit of a magic outcome, actually. It's really seeing a significant fall in the number of external administrations between December last year and January this year. There will be some seasonality to that, but even allowing for that, you're looking at a number of external administrations, first month of this year, numbering 228. Now, you know, the average over the last 3 years is 730 per month. The average over the last year is 476 per month. So even though it's not a seasonally adjusted number, it still is a remarkable and very encouraging decline that we've seen in the first month of this year. What we need to track closely is what happens in the June quarter, following on from hopefully consistent lower results in the March quarter. We need to have a profile of the first half of this year where we consistently see external administrations averaging considerably lower than they did in 2020 before we get too carried away. But by gee, we certainly got off to a cracker of a start in January, and that really is very encouraging. And this will be a key metric, I think, for us to keep our eye on as we continue to move through the year. We can also see that external administrations across different states and territories have actually fallen January this year compared to December next year. But when you look at it on an annual basis, you actually find that we've had quite a hefty fall, 53% fall. I'd take the 63% decline with a little bit of a grain of salt, but certainly a very encouraging result. And when we analyse the Creditor Watch data on a geographical basis by state and territory, there is a pretty clear trend emerging where you are seeing lower external administrations than you were through much of 2020, which of course is consistent with what we were previously looking at, where you've seen that that big fall in administrations in the month of January. I might just take you, if I can, back to link up some of these industries with what's going on with the states and territories. If you look at healthcare and social assistance, you have very large private enterprises in these areas providing elective surgery, for example, providing health services in terms of physiotherapy, in terms of chiropractors, dentists, or a whole range of industries have really suffered under the weight of COVID restrictions, and it'll take some time for that to sort of get back on track. Transport, postal and warehousing, I'm a little bit more optimistic about, I guess, because I think as retail demand starts to pick up again and we see greater volumes, walking the streets, so to speak, as well as shopping online, then I think you will find that you get more back on the road, and you will start seeing an improvement in the business conditions of those in that industry. That is not to say that some may have, unfortunately, found it difficult to carry on in the current environment, but certainly we're talking about an improving environment. And that's an encouraging thing. If you take warehousing, for example, that'll benefit greatly from a recovery in the retail sector, which I touched on also in terms of the wholesale trade sector and the likelihood of it actually starting to recover as well. So hopefully what we see from now on is a persistent trend where the average number of external administrations is lower than it was. And I think it's reasonable to expect that to be the profile that will develop. Not necessarily saying it's going to develop overnight and that all of a sudden in February and March, we're going to have all this evidence that everything's getting back to normal. But over probably a 6-month time frame, I think the situation will improve, and I think that will be very encouraging. I think we go back to payment times. You'd say the same thing. We will see some recovery there, and I think if you take probably the left 2/3 of the chart, I would suggest. I think these are all industries that have a quite reasonable chance of having a much stronger 2021 and a much stronger first half of 2021 in particular than they did 12 months earlier, where as we got into March, we got that massive thump to activity in the second quarter, and it really, as we all know, just changed the whole dynamic of everything. We really need to see things turn around. But I think we're getting to a point where we should have some positive expectation that these businesses are going to have reasonably significant improvement to their results as they enter this year compared to last year. As I said, we've got to watch the 5 on the other side, and we'll be analysing data here on those very closely in the coming months for any additional insights that might come to pass. Now, just briefly on back on the states to sort of wrap the administrations up, if you like. New South Wales is performing very well. Victoria was expected to perform a lot worse than it did because of the second lockdown, but a range of different indicators and Creditor Watch data certainly supports this, show that the state of Victoria is recovering much more swiftly and more broadly than people thought was going to be the case when everyone faced that really difficult period of time where you had a fairly lengthy and rigorous lockdown period. Probably seeing an aggregate trend in Queensland that could be a little bit better than it is. Certainly payment times on average, external administrations rather, on average are coming down, but would have liked to see a little bit clearer improvement than we currently are. But overall, if you look at the eastern seaboard, where the bulk of the business is, because that's where the bulk of the population is based, you are finding that external administrations are looking considerably better than they were not all that many months ago, actually, and also certainly better than we expected. Just briefly, in terms of the smaller states and territories, if you look at it in terms of a ratio to overall business activity in these geographical areas, then you would say that South Australia is a little bit on the high side. Western Australia, the ACT, the NT and Tasmania roughly as you would expect them to be, I suggest. Perhaps a little bit more of a chunky number in Western Australia than would have been the case if you hadn't had that extended hard border lockdown in the west that prevented a lot of business transactions from occurring between Western Australia and the eastern seaboard in particular. Yeah, overall a pretty good profile. Now we do have a poll for you today that we would really appreciate you participating in. The question is, would you like to be contacted by a member of the Creditor Watch team? We'd really appreciate your participation in that poll. I thank you all very much for your time this afternoon. I hope the information I've been able to provide has been valuable to you. As I said at the start, the information will be available to you post the webinar. I wish you all a very good afternoon, and once again, thanks very much for your time.